72 hours. That's the window you have before a critical industrial report drops that could ignite silver prices in a way we haven't seen since 1980. According to recent industry sources, Larry Fink, CEO of BlackRock, the world's largest asset manager with over $9 trillion under management, has reportedly increased silver exposure across multiple funds. Not gradually, aggressively. And he's not operating in isolation. Major players like Morgan Stanley, Citigroup, and Sprott Asset Management are reportedly positioning similarly. Here's what they're seeing that retail investors are missing. There's a supply crisis that's been building for approximately 8 consecutive years, something that explains why institutional silver accumulation isn't speculation, it could be necessity. I'll reveal exactly what's happening. But first, you need to understand the structural trap the silver market is in right now. December 12th, a major mining consortium releases production data, and the narrative could shift permanently. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Right now, at this precise moment, the silver market is reportedly facing what industry analysts call a perfect storm scenario. Demand surging to record levels according to recent estimates, driven by solar panel manufacturing, electric vehicle production, and traditional investment. Supply? Mining output reportedly declining for the 3rd consecutive year in some projections. Existing stockpiles depleting faster than any period since the early 2000s. The math doesn't work. The physical market can't sustain current consumption rates. And that's exactly why silver has reportedly climbed over 45% in the past year, outpacing nearly every major commodity. Now, market historians point to this supply-demand imbalance happening twice before in modern history. And both times, silver didn't just appreciate, it absolutely exploded. Let me walk you through the pattern. January 1979, silver trades at approximately $6 per ounce. Paul Volcker hasn't raised rates yet. Inflation is running rampant, trust in the dollar eroding. Most investors remain focused on gold. They miss what's happening in silver. The smart money sees the industrial demand surge, silver needed for photography, electronics, emerging technologies. By January 1980, around $50, that's not a bull market. That's a supply shock meeting panic buying. Roughly 733% gain in 12 months. And it didn't happen because silver suddenly became more valuable. It happened because the market realized there wasn't enough physical metal to meet demand. Industrial users panicked. Investment demand compounded. Exchanges changed margin requirements. When physical scarcity meets monetary uncertainty, silver becomes the pressure valve. Fast forward to 2008. Silver is trading at approximately $9 per ounce after the financial crisis crash. Nobody wants it. Industrial demand collapsed. The new normal, they say. Perpetual economic stagnation. Ben Bernanke has a response. Quantitative easing. QE1, QE2, QE3. Trillions pumped into the system. Meanwhile, something else is happening. Smartphones explode onto the market. Solar panels begin scaling. Electric vehicles transition from concept to reality. Silver demand from these sectors starts climbing, except mine supply can't keep pace. By 2011, silver hits around $48, from approximately $9 to $48, roughly 433%. When central banks flood the system with liquidity and industrial demand accelerate simultaneously, when supply constraints become obvious, silver doesn't just rise, it detonates. Now here's where the situation becomes critical. What's unfolding in 2025 could eclipse both those periods, because this time we may have 3 catalysts converging at once. Silver approximately $32 per ounce, up roughly 45% year to date. Reportedly one of the strongest performances across all asset classes. But look at what's happening in the fundamentals. Recent industry reports suggest global solar panel installations could exceed 500 gigawatts annually. Each gigawatt reportedly requires around 11 tons of silver, according to some technical estimates. That's approximately 5,500 Thalard tons annually just from solar, and projections suggest this could double by 2027. Electric vehicle production reportedly targeting 20 million units annually by some manufacturer forecasts. Each EV uses approximately 25-50 grams of silver depending on the model. That's another 1,000 tons annually and climbing. Electronics, 5G infrastructure, medical devices, water purification. Industrial demand reportedly consuming around 60% of annual silver supply, according to market analysts. This isn't speculative demand. This is structural consumption that can't be substituted away. And at the same time, mine supply reportedly declining. Recent data suggests global silver mine production around 830 million ounces, down from approximately 900 million ounces several years ago. Why? Analysts point to declining ore grades, mining costs escalating, environmental regulations tightening, geopolitical instability in key producing regions. And here's the alarming part. Many silver deposits are byproducts of copper, zinc, and lead mining. As those operations become less profitable, silver production falls as a secondary effect. Primary silver mines alone can't fill the gap. So the market is trapped. Completely, utterly, fundamentally trapped. Industrial demand accelerating, mine supply declining, inventory levels depleting. There is no easy supply response. Wednesday's industrial report is expected to confirm what market participants already suspect: physical deficits reaching critical levels. Some commodity analysts predict the data could show deficits exceeding 200 million ounces annually. The last time deficits reached these proportions, around 2021-2022, silver rallied from approximately $18 to $30 in months. That's how tight the fundamental balance is. This deficit isn't a temporary phenomenon. It's a structural reality. A reality of something much bigger reshaping the entire commodity complex. And I'm about to show you exactly what institutional money sees. Remember, approximately 8 years ago? The Silver Institute reportedly began documenting persistent supply deficits. And according to various industry publications, those deficits haven't reversed. Not for a single year. 8 consecutive years of deficits. Cumulative shortfall now reportedly exceeding 1 billion ounces according to some estimates. That's roughly 1 full year of global mine production drawn down from existing stockpiles. Where did it go? Consumed irreversibly in industrial applications. Wall Street isn't missing this. BlackRock reportedly increased silver ETF holdings. Morgan Stanley Commodity Desk reportedly positioning for higher prices, according to trading desk sources. Sprott Physical Silver Trust seeing inflows that haven't been witnessed since around 2020. This isn't retail enthusiasm. This looks like institutional repositioning. Repositioning for what? The potential recognition that silver could be the most undervalued strategic metal on the planet. Silver to gold ratio, currently approximately 84 to 1, meaning you need around 84 ounces of silver to buy 1 ounce of gold. Historical average, reportedly closer to 60 to 1, according to long-term data. During periods of industrial demand surges or monetary instability, it's compressed to around 30 to 1. In 1980, it briefly touched 15 to 1. If we simply revert to the historical mean of 60 to 1 with gold at current levels around 4,200, silver would trade near $70. That's over 100% from current prices. If we see compression toward 30 to 1, silver could approach $140. That's not speculation. That's just ratio normalization based on historical precedent. Meanwhile, institutional investors reportedly remain dramatically underweight. Recent surveys suggest silver comprises less than 0.5% of typical institutional portfolios, according to asset allocation studies. Compare that to gold at around 2 to 3%. As institutions recognize the supply deficit, as they model out industrial demand growth, as they calculate potential returns, they need to increase exposure. But here's the problem. The silver market is small. Total above-ground investment silver reportedly around 3 billion ounces, according to some estimates. At current prices, that's roughly $95 billion. For context, Apple's cash position reportedly exceeds $160 billion. One company holds more cash than the entire above-ground investment silver market is worth. If even a fraction of institutional money pivots toward silver, there isn't enough supply to accommodate demand without massive price appreciation. Industry experts have described this dynamic as a potential liquidity crisis in the making. When large pools of capital chase limited physical supply, prices don't adjust gradually. They gap violently. This isn't just a trade opportunity. This could be a once-in-a-generation wealth transfer from those who don't understand supply fundamentals to those who do. And it's unfolding right now. So let's get tactical. Current price approximately 58. If silver breaks through resistance around $59 after Wednesday's industrial data release, the technical door opens toward $62. And if it clears that level decisively, some technical analysts suggest potential for a measured move toward $70, the psychological round number in 1980 peak. Because at that point, it's not just about fundamentals anymore. It's momentum. It's algorithmic buying. It's industrial users realizing they need to secure supply at any price. It's retail investors seeing headlines. It's institutions scrambling to increase allocations before quarterly rebalancing. But here's what concerns me most: the complacency. Recent sentiment surveys reportedly show silver positioning remaining relatively neutral despite the rally, according to QT data. Options markets suggesting implied volatility still relatively subdued. Credit Suisse commodity analysts noting that silver remains underowned and underappreciated relative to fundamental outlook. The market isn't priced for what's potentially coming. It's priced for business, as usual. But business as usual ended when industrial demand started consuming supply faster than miners could produce it. Look at the derivative exposure. Recent estimates suggest paper silver contracts reportedly exceeding physical supply by ratios of 100 to 1 or more in some over-the-counter markets. Banks, trading desks, institutions holding massive short positions betting prices decline or remain stable. What happens when those positions need to be covered during a supply squeeze? 1980 provides a template. Hunt Brothers attempted to corner the silver market. Exchanges changed rules. Margin requirements increased. Yet prices still exploded because physical demand overwhelmed paper positioning. This time, there's no corner. There's genuine industrial consumption creating deficits. The squeeze would be organic, driven by real-world supply-demand imbalances, not speculation. So what's the play for those paying attention? Some market participants are reportedly accumulating physical silver, recognizing paper contracts may not deliver during a crisis. Others positioning through mining equities, understanding operational leverage to rising prices. Still others using option strategies, targeting asymmetric risk-reward profiles. The specific approach matters less than the recognition. We may be in the early innings of a structural silver bull market driven by fundamentals that can't be easily resolved. Wednesday's report is just the catalyst. The real story is years of underinvestment in supply meeting, years of accelerating industrial demand. It's institutions waking up to a market they've ignored. It's a supply-demand imbalance that mathematics suggests can only be resolved through higher prices, much higher prices. Because when you can't increase supply quickly and demand is structurally rising, price is the only adjustment mechanism. And that adjustment could be violent, swift, and shocking to those who aren't positioned. The institutional pivot to silver isn't happening because Wall Street suddenly loves precious metals. It's happening because the smartest money in the world is running the same calculations. And those calculations point to the same conclusion. Silver at $70 could be one of the most asymmetric opportunities in the commodity complex. Not because of speculation, because of mathematics, because of physics, because you can't manufacture silver out of thin air. You can't build solar panels, electric vehicles, or modern electronics without it. 48 hours, that's what you have. Use them wisely.